Hey guys, welcome to our Q2 chart pack. Good to be back with you all. Hope everybody is having an enjoyable start to the summer. Obviously, it goes without saying we had a very rough month of June. We see from this chart that markets were starting to come back from the bottoms around June 15th, rallying, thinking that inflation had eased, and then we got that inflation report towards the end of June, and we saw a massive fall again, 4% within a week. Really wild market, wild ride for June. If we zoom out a little bit, we see the quarter was even worse. Lots of volatility, increased volatility, most 1% moves in quite some time, 50 plus years. Massive volatility as we digest the impact of the Federal Reserve's rate increases, economic data about inflation. Go to the half of a year to zoom out even further, 6 months, worst 6 month start for the S&P 500 since 1970. Just see a complete fall off from January. Basically, lots of volatility. Strap in your seatbelts, as we've been talking about for quite some time. But if we zoom out a little bit further and we want to have a long-term perspective, because as we know, markets can go down over a 1-year period, over a 2-year period, even over a 3-year period. But as we zoom out even further, we see markets are still way up from the COVID lows, touching almost pre-COVID levels and close to it towards the end of the second quarter, but still up substantially over a 3-year period. So keep your timeline is very, very important. We're hearing from a lot of folks that either they invested money that they may need in a short period of time, or this isn't really long-term money. Really hard to predict in these short-term cycles. So if you need the money sooner, should not be exposed to risk markets. Lots of the markets were predicated based on treasury rates. So let's go to that slide. We saw massive move in the short-term rates from the beginning of the year, which is a main reason why the markets have fallen. So we have rates spiking. We talked about this on our stories and on the Sherman Wealth Snap. So if you're not subscribed, let us know, info at Sherman Wealth. But we saw a breakout move from that 1% range all the way up the last 3 months. Massive volatility. We saw the 2-year and 5-year and 10-year yield curve invert, meaning that short-term treasury rates were paying more than long-term treasury rates, which sparked recession fears. So, and we saw massive moves back down from the high of the 10-year treasury rates in the mid threes all the way below 3%. Just got a jobless claims number this morning, so rates are back above 3%, slightly higher than what you see here. Still massive moves. If we zoom out and remember where we were at COVID, close to zero or negative real yields, massive move in rates. We see this impacting mortgage rates. So people are concerned about the housing market, of course, fearing inflation and other things within the economy that are tied to interest rates, short-term debt, variable rate debt, such as student loans, cars, and mortgages, of course, as we said. Also setting off massive moves in the oil markets. Look at that massive spike in oil from April 2020, when you couldn't even get people on the road to hold your oil or to store your oil. Now it's up big, and we're seeing that at the pump. Obviously, within the last 2 weeks, as some of this interest rates have fallen, commodities have fallen, and the supply chain has opened up, We see gas prices coming down a little. We'll see how that impacts the consumer's wallet as summer season is upon us. Inflation component. So we're talking about energy, a massive component of inflation. Also, as many of you know, because we've been following it, new and used vehicles, big component. All these things are starting to hopefully ease. But as we talked about at the beginning, the market was anticipating this easing on May's data. It went up, did not fall as we thought, and spiked back up from April. As you see, March to April, there was a blip in inflationary numbers, and the market was very caught off guard with May's numbers spiking higher, as you see on this chart. Another inflation spiking to 50-year levels, crazy levels of inflation. We want to hear from you as to what you feel like has had the greatest impact on your wallet. And of course, consumer sentiment at all-time lows. When this usually troughs out, as you can see, the markets usually rebound. So we won't know until we're out of this. But that massive spike down, and if we start to see an increase in consumer confidence data, usually the market follows. People's livelihood obviously tied to the markets. Hearing from a lot of people just around the streets, getting a haircut today and hearing from the stylist that he couldn't believe his 401k and what it's like. So we want to make sure that people understand to have a long-term perspective, why you're investing in the first place. Obviously, your consumer confidence is affected by your balances in your 401k and other assets that you own. So please let us know where you're feeling the pain, either at the pump, inflation, is it wage pressure? Are you a small business owner and can't keep up with the input costs of inflation? All this great stuff and more. Let us know what you think. Comment below if you enjoyed these charts and want to hear more. Info@shermanwealth.com, and we will talk to you soon.